A lot of people think that buying undervalued stock means buying cheap stocks or stocks that are trading at a low price to earnings ratio. But let me tell you that it is absolutely incorrect. Undervalued stocks are stocks of companies that are fundamentally strong and have a good business, but are currently trading at a discount to their actual worth. And your goal as a value investor is to find high quality businesses that are currently trading at a cheap valuation. In this video, I will tell you the key metrics that will help you find these high quality businesses that are trading at cheap valuations. My name is Kanak and welcome back to my channel. Subscribe to my channel for interesting content from the world of finance, investing and economics. The first very important metric that tells about the quality of the business is return on invested capital. Now let me explain you this metric through a simple example. Let's say you start a business by investing about $100,000 of your capital. At the end of the year, you generate a profit of $10,000. Your return on capital is 10%. That is, you generated $10,000 of return on an investment of about $100,000. This metric tells how efficiently the business is using its capital. And the average return on invested capital of businesses in S&P 500 is about 9%. So, by filtering out businesses that generate more than 9% of returns on the invested capital, you will be getting a list of businesses that are above average in terms of quality. The second very important metric that you should be looking for is revenue growth rate. Even if a business is generating high return on capital but it has declining revenue, then that is a cause of concern. Revenues could be declining due to a host of reasons, such as the industry itself is shrinking, competition is taking away the business, or the product or the service of the company is subpar and that's why consumers are leaving the business. So it is important to filter out companies that are generating consistent and high growth in revenues. The average growth in revenue of companies in S&P 500 is about 5%. So in order to get businesses that are growing at above average rates, you want to filter out businesses with revenue growth greater than 5%. The third key metric that tells about the riskiness of the business is debt to equity. A business that has borrowed more money relative to the invested capital would be riskier than the business that has borrowed less money. The reason debt becomes a risk is because it could eventually lead to a default if in case the business is not able to generate revenues to service the loan. So businesses with lower debt relative to their equity would be considered safer and hence higher quality. The fourth and most important factor that you must consider is valuation. Valuation is nothing but the price that you're paying in order to buy the business. For a business that is worth $1, you don't want to be paying $2. As a value investor, you are looking for bargains and you want to pay 50 cents for a business that is worth $1. Now there are three commonly used valuation metrics. The first is price to earnings ratio, which tells you what is the price that you're paying in order to buy the company relative to the profit that the business generates. The second metric is price to book value. This metric tells you what is the price that you're paying relative to the book value of the business. Book value is nothing but net assets, which means assets remaining after paying back all the debt. The third valuation metric is price to sales. This metric tells you what is the price that you're paying for the business relative to the sales that the business is generating. The price to sales metric is usually used for early stage companies that are not yet profitable. Finally, to summarize all the four key components, as a value investor, you want to filter out businesses that generate high return on capital, that show consistent growth in their revenues, that have low debt relative to their equity, and that are currently trading at a cheaper valuation. All these factors combined will help you find companies that are undervalued, which means high quality businesses that are currently trading at cheaper valuation.